All right, let's dive in. Today, we're putting a fascinating company, TransAlta Corporation, under the microscope. We have one very specific mission, and it really all boils down to a single, powerful question. So here's the deal. To triple your money in 16 years, the math is pretty simple. You need to get an average annual return of about 9%. That's our magic number, our benchmark for this entire analysis. The big question is, can TransAlta actually pull it off? So, who is TransAlta? Well, they're an independent power generator. They've got a whole mix of assets: wind, hydro, natural gas, you name it. But that word independent is super important. See, unlike a regulated utility that gets guaranteed prices, TransAlta's income can be way more up and down because they sell their power on the open market. And that brings us right back to our main goal. Everything, and I mean everything we look at today, the good, the bad, the numbers, it's all going to be seen through this one lens. Can this stock get us to that 9% annual return? Let's get into it. Okay, first up, we're going to pop the hood and take a good look at the company's financial engine. What's running smoothly? What's making a weird noise? And what does it all mean for the stock's actual value? Let's kick things off with a big positive. $475 million, that's TransAlta's free cash flow over the past year. Now, think of this as the pure cash profit the business spits out. It's a really strong sign of a healthy company. But as we're about to see, it is only one side of the coin. And this just perfectly captures the entire story of TransAlta for an investor. It's a constant tug of war. On one side, you have that incredible ability to generate cash. But on the other side, you've got maybe the single biggest worry here: a weak balance sheet that is just loaded with debt. And here's that worry in number form: 3.97. That's the company's debt-to-equity ratio. What that means is for every $1 of their own money, they've borrowed almost $4. Oof. In a world with rising interest rates, paying off all that debt could seriously start to eat into the money that should be going to shareholders. So, with all that said, what is this company actually worth? Well, if you run a couple of different valuation models and kind of blend the results, you land on an intrinsic value of about $18.10 per share. And guess what? The stock's trading right around that number today, which tells us the market pretty much has it valued correctly. There's no obvious screaming bargain here.
Okay, now that we've got a handle on the numbers, let's zoom out and look at the bigger picture. We're going to break down TransAlta's strategic position with a classic SWOT analysis. You know, strengths, weaknesses, opportunities, and threats.
What's really interesting here is the weighting. The two factors that have the biggest impacts are, you guessed it, the ultimate strength. Hey, everybody needs electricity. And the biggest weakness, that debt we just keep talking about. It's this constant battle that ultimately grades TransAlta as a decent, moderate quality company, but one with some pretty significant financial risk attached. Just to hammer it home, these are the four big risks you need to keep on your radar. That heavy debt is number one, for sure. But you also have to watch out for politicians changing the rules, wild swings in electricity prices, and the chance that the company might issue more shares, which would water down your ownership.
Okay, so we understand the valuation, we understand the risks. Now let's get practical. What do a few different future scenarios look like, and what price would we actually need to buy this stock at to hit our goals?
Let's start with the pessimistic view, the bear case. If growth slows down and the market gets more and more nervous about all that debt, the real value of the stock could drop to around $14 a share. That's kind of our downside. Now for the base case, what we think is the most likely outcome. This lands us right back at that $18 valuation we saw earlier. This is basically the business as usual scenario, assuming things just keep chugging along as they are. And what if everything goes right? That's the bull case. If TransAlta can speed up its move to renewables and really get a handle on its debt, this stock could be worth as much as $24. That's the potential upside we're all hoping for. Okay, this slide right here, this is the practical tool. This is the one you might want to take a screenshot of. It shows you the exact price you need to buy at to hit our 9% return target, depending on how long you want to hold the stock. And for a 16-year mission to triple our money, the answer is crystal clear. You've got to buy in at $14.70. We can even flip this on its head. This chart shows what price you need to pay today to get different returns over that same 16-year period. You want a 10% return? You got to be patient and buy near $13.90. You'd be happy with 5%? You could probably buy at today's price. It all comes down to your personal goals. So,
After digging through all the numbers, weighing the risks, and looking at all the possible futures, what's the final verdict? Where does all this leave us?
The analysis leads to a really clear and simple verdict. The recommendation is a hold for anyone who already owns the stock. For new investors, the advice is to wait for a better price, ideally somewhere around the $15 mark. At its current price, the potential reward just doesn't seem to be worth the risk you're taking on. So let's just quickly recap the most important takeaways. TransAlta makes fantastic cash flow, but it's being held back by a mountain of debt. Right now, the stock is fairly valued, which means there's not much room for error. If you're serious about that 9% return, you need to buy the stock on sale, near $14.70. And finally, remember what this is, a classic infrastructure play for stable dividends and moderate growth, not some high-flying tech stock. And that's our deep dive on TransAlta. The story here is a classic tug-of-war between strong cash generation and pretty significant debt risk. So what company's balance sheet should we put under the microscope next? Let us know in the comments below, and we'll see you for the next one.